This is where the majority of tax benefits come in play. I mean, how else could you actually give your child $1 million property without paying any taxes on it? Without anyone paying taxes on it? Could you live on $1 per year? Why not? People like Elon Musk, Mark Zuckerberg, Evan Spiegel, Jack Dorsey, Larry Page, and Sergey Brin live on just $1 per year. No, they don't. But they get paid only $1 per year in salary, so how do they live? And the answer is BBD. Buy, borrow, die. A 100% legal method the truly wealthy use to minimize taxes and maximize wealth. Look, buzzwords, I know, but it's true. In this video, we're going to talk about how they buy assets, borrow against them, and die. The first step of the BBD strategy is to buy appreciating assets. Now, an asset is something that you own that is expected to provide future economic benefits. Look, that's the corporate definition. It's something you own to make you money. An appreciating asset is something that you own that is expected to increase in value over time. Now, examples of appreciating assets that are used for the BBD strategy are real estate, like rental properties, stocks and bonds, businesses, really any kind to be honest, art and collectible cars, that's right, Picasso and a Porsche, cryptocurrencies, farms and forests, and precious metals like gold and silver. Literally anything that is usually expected to increase over time. Now, buying appreciating assets is important in this strategy because the value of the asset creates wealth over time, but you won't get taxed until you sell. The second step of the BBD strategy is to borrow against those appreciating assets because loans are not considered taxable income. This means you can access the funds without selling assets. And before you ask, the answer is yes. You can borrow against all of those asset types that I've mentioned. Now, real estate is pretty simple. It's home equity loans and home equity lines of credits for personal homes and commercial equity line of credit for commercial property. Now, in those situations, you can get anywhere from 60 to 90% of the value of the property. Now, for stocks and bonds, you can get two types of loans. You can get margin loans, which are loans against the value of your investment portfolio. And the second is securities-based lending, which is essentially the same thing where you pledge your investment portfolio for a line of credit. Now, normally that's a lower interest rate than a margin loan. Now, if you own a business, you have plenty of options to get personal loans from private banks using your business as collateral. Art and collectible cars. Look, it's hip, it's cool, it's new. It's called art-backed finance. Companies like Sotheby's and Christie's, which are huge art auction houses, will usually give you around 50% of the value of the art in the form of a personal loan. And you've got cryptocurrencies. Yeah. Crypto-backed loans exist. It's basically the same thing as putting your stocks and bonds up for collateral. In return, you get a percentage of that as a loan. Farms and forests, they're very similar to businesses. You go to a private bank while using your farmland or your timberland as collateral, and they give you a personal loan based on that. And then you have precious metals. I'm talking gold, silver, copper, basically anything that's a metal. And it's very similar to stocks and bonds. You put those up for collateral and you get a percentage of that as a loan. Now, really quick though, let's talk about the pros and cons of borrowing against your appreciating assets. Pros are pretty simple. You have access to cash without selling the assets. That's huge. Usually you have a lower interest rate compared to standard borrowing options, and you have flexibility in how you can use the funds. It's not a loan where you have to buy a house. It's a loan where you can actually just live. Now, the cons are a bit more complex. If you can't pay the loan back, you lose the asset. Interest payments can start adding up to where it's just too much, and if the value of your asset goes down, your loan could be called, meaning they could demand repayment immediately. Now, you have three options in order to pay back that debt. The first is called asset appreciation. If your asset goes up in value over time, you can refinance and pay off the older loans with the newer loans. The second option is called income generation. Basically, hopefully, your asset makes you money, and you can use that money to pay down the debt. Now, the third option, or estate planning, is you don't pay it back. You die. The third and final step of the BBD strategy is to die. When the person owns the appreciating asset dies, their heir receives the asset on a stepped-up basis. Let's dive deeper into what this really means. We'll use you as an example. Now, the first thing is you buy. You buy a rental property for $1 million. Then you borrow and live. You borrow $500,000 against it in a commercial equity line of credit. You use that money to continually fund your lifestyle. You use the rental income to pay down the debt throughout the years. And yes, that rental income is taxable, but that's not what we're talking about here. And then third, you die. You die. By the time you die, though, you still have a $300,000 loan against the rental property, but now the property is worth $1.5 million. The rental property passes down to your daughter on a stepped-up basis. This means that the tax basis of the property is now the fair market value of $1.5 million. She has two options now. First, she sells a property, pays $0 in capital gains taxes, and pay back the loan. Second, she buys, borrows, and dies. She goes to the bank and gets a $750,000 loan against the rental property, pays off the $300,000 old loan, and lives off the $450,000, and so on. And you might ask, well, why isn't there an estate tax? Well, that's because the US has an estate tax exemption of $13.61 million. Now you can see why dying is important in the BBD strategy. Look, this is where the majority of tax benefits come in play. I mean, how else could you actually give your child a $1 million property without paying any taxes on it? Without anyone paying taxes on it. Now look, I know you want to know the actual nitty-gritty tax math, so let's do that here. Now, what would happen if you sold the property before you died instead?
Okay, let's first go through the buy, borrow, and die tax applications. The first is a purchase price of $1 million and our original loan of $500,000. Our fair market value is $1.5 million with our remaining loan of $300,000. Currently, the father's tax basis is $1 million. That's from his original purchase price. Now, the daughter's tax basis will remain unchanged. If the property passes it on to her, she'll have a stepped up basis regardless at $1.5 million. Now let's say for this situation, both the father's and daughter's income are very high earners. Remember, the BBD strategy takes place in a lot of wealthy families. So let's say they both make $600,000 a year. This allows us to simplify some math. And in this situation, we're going to ignore depreciation and anything like depreciation recapture taxes. So let's go through scenario A. Okay. So, scenario A. The father sells the investment property, dies, passes it on to the daughter. We have a sale price of $1.5 million. The father's tax basis of $1 million, which is what he purchased it for, which means we have a capital gain of $500,000. Now, the applicable tax for a capital gain at his income level would be $100,000. Now that's 20%. How do we figure that out? Well, right over here, we can see that capital gains of 20% applies to the extent that your taxable income exceeds the threshold set for the 15% capital gain rate. So at capital gain rates of 15% applies if your taxable income is more than $44,625, but less than or equal to $492,300. Because they have an income over $600,000, 20% applies. Okay. So far we have 20% capital gains tax. Now let's go and talk about net investment income tax. Now, what is net investment income tax? The net investment income tax is imposed by Section 1411 of Internal Revenue Code. The tax has a rate of 3.8% to certain net investment income of individuals, estates, and trusts that have income above a statutory threshold amount. Now, what kind of stuff is included in the net investment income? Essentially, in this situation, gain from the sale of real estate, including gain from the sale of a second home that is not primary residence. Now, because this is an investment real estate, this falls under it. Now, what individuals are subject to net investment income tax? Pretty much if you make over $200,000 as a single individual, which for these individuals, they qualify because they make over $600,000. Now, if you have income greater than the threshold, so they have $600,000 compared to $200,000, that means we have to figure out some math and figure out what their tax rate is going to be based on. Basically, the difference between the threshold amount in your income or how much the gain is, whichever is lesser. Okay, so let's go ahead and go back to our lead sheet. Now, the threshold amount is $200,000 per the IRS that we see here, and the excess income is $900,000. We take this by taking their $600,000 regular income, adding the capital gain of $500,000, and then subtracting that $200,000 threshold amount. That leaves us with an excess income of $900,000. Now, which basis do we use? Well, according to this, we use whichever is based on the lesser amount, whatever is the difference between the threshold and the income or the capital gain. So in this situation, it's the capital gain. Now, because the capital gain is $500,000, We take our $500,000, multiply it by our 3.8%, and that's $19,000, which gives us a total tax of $119,000 if the father sells the property right before he dies. $119,000 for no reason, because guess what? In scenario B, the father follows the BBD strategy. There's zero tax. Completely zero tax. Her basis goes up to $1.5 million. She could sell it the day after she gets the property and pay 0% tax everywhere. What an amazing strategy. And a difference of $119,000. That is a six-figure income. How crazy is that?
That's the BBD strategy, the buy, borrow, die strategy. You buy an appreciating asset, you borrow against it, and you die and pass it on to your children on a stepped up basis. That's BBD in a nutshell. Is it legal? Yeah, it is. Is it ethical? Kind of. You're allowed to do it also, so it's fair in that sense. Now, is it equitable? I don't know. What do you think? Now look, I'm on my way to becoming the #1 personal finance channel on YouTube because I want you to change the way you think about your finances so that way you can become financially fit and free. Now, if you like today's video, please click that like button and subscribe for more videos like this, including street quizzes, budget breakdowns, money makeovers, and complete guides and tutorials. Thanks for watching, and check out our last video on HSAs. In it, I show you the best way to set up and use your health savings account, or what I call a health investment account. To borrow or not to borrow? That's the question. Borrowing against your appreciating assets. Thanks for watching again.
All right, I think we got it.
Okay, we're done.